Hello, welcome to this week's podcast brought to you by the Good Money Guide and our sponsors Pepperstone, who are a multi-regulated CFD broker providing trading services in forex, stocks and commodities in multiple destinations. I'm Michael Hewson, and joining me again is Pepperstone Senior Market Strategist Michael Brown. Good morning, Michael. Or good
Very
afternoon,
good.
Michael, even.
I was going to say a very good afternoon to you too, mate.
Yeah,
Very happy Thursday. I'll let you off though because it has been one of those weeks, hasn't it?
one of many. Um, I think obviously looking at what's taken place this week, there's so much to talk about.
Mm,
Not only in the US, because obviously we've seen US data make a comeback, payrolls, weekly jobless claims, a virtual smorgasbord of data to wade through. But we've also got to look at the UK, and obviously we'll be looking ahead to next week's budget finally.
that'll cheer us all up, I'm sure.
But I'm certainly not convinced that it will basically clear the fog of gloom and doom that's
Mm.
prevailing around the UK economy like a bad smell. Um, so, before we get on to the risk warning, any initial thoughts on stock markets this week?
Yeah, well, it's been a bit of a weird week. Certainly a choppy and indecisive one. I mean, I'm pretty sure the S&P is now trading roughly where it was at the back end of last week, although I don't have a chart in front of me, but that does mask an incredible level of volatility. I think the weird thing about the sell-off that we saw earlier in the week on Monday and on Tuesday is that again, there wasn't an obvious sort of smoking gun, an obvious catalyst behind the move. I think it's clear that investors are taking a more skeptical view of the whole sort of AI theme. That's been very, very clear, and some of the valuations that are on offer there. But then we had those earnings from Nvidia after the close yesterday on Wednesday, which we'll just discuss. They blew the lights out, frankly, and this morning everyone's sort of woken up and it's all fine and dandy once again.
Well, you say that, but I think the sell-off happened, I think, as a consequence of obviously concerns about AI, but also I think the fact that the Fed was likely or wasn't likely to cut rates in December. So
Mm.
there's been shifting expectations on that, and obviously we'll cover that when we go into greater detail in the wake of the risk warning, which I better do before I forget.
Yes, you best.
Otherwise, we'll start to get into it and completely forget about the compliance
Mm.
details, which we all have to do. So, risk warning, here we go. The information provided here, whether from a third party or not, isn't to be considered as a recommendation or an offer to buy or sell, or the solicitation of an offer to buy or sell any security, financial product or instrument, or to participate in any particular trading strategy. We advise any readers, viewers or listeners of this content to seek their own advice. Spread bets and CFDs are complex instruments and come with a high degree of risk of losing money rapidly due to leverage. 72% of retail investor accounts lose money when trading spread bets and CFDs with this provider. Okay. We just had non-farm payrolls. What do you make of it?
Well, it's an interesting one. So, at the headline level, it looks like a pretty decent payrolls report. The US economy added 119,000 jobs in September, which was above the top end of the forecast range. But then when you start to dig into the details of the report, you start to see some of the shine taken off of that number. You had a significant net downward revision to the prior 2 months worth of data, down 33,000, which in turn saw employment actually contract by 4,000 in the month of August. And then if you move back to the September data, which is obviously a little bit stale at this point, but of that 119,000, 60,000 of those job gains came from education and from healthcare, and about 50,000 of them came from leisure and hospitality, which, fine, a job's a job is one way you could look at it, but also you would argue that actually these are, well, certainly healthcare mechanically grows because of the aging population. Leisure and hospitality is not necessarily durable jobs growth. So I think overall it's still a picture of a labour market that is stalling, frankly, in the United States.
And certainly not much of a reaction either in terms of the bond markets when it comes
Mm.
to potential rate cut expectations in December.
Yes, exactly. And I think actually the bigger driver of those December rate cut expectations has been the minutes that we got from the October FOMC this week, which was actually pointing to, I would say, the committee being more divided than we'd expected, with many officials not seeing the case for a rate cut in December. And when you add on to that the fact that we won't be getting either the October or the November jobs report until after that last FOMC meeting of the year, it
Oh,
does
really?
feel,
Okay.
yeah, so that's not coming out until the 16th of December now. It was due on the 5th. It just
Right.
feels as if the balance of risks is increasingly tilting in favour of the Fed standing pat next month.
That is interesting that obviously they've had to delay it until the 16th. I'm guessing
Mm.
because there isn't time to pull the 2 months together because they're not going to be releasing any data from October at all. Is that correct?
Yes, exactly that. So, well, we're getting sort of half the October data. So we'll get the establishment survey, which is where you get the non-farm payrolls number
Mm.
from. But what we won't get is the household survey. So we won't get the unemployment rate and we won't get the participation rate either. So we'll only have sort of 50% of the picture for October anyway. You'll have a full picture for November. But regardless, the Fed will have neither of these data points when they next meet.
You mean to say that they won't get an early briefing? I mean, it's only 2 days before, isn't it?
I don't know. Actually, is the completely honest answer. There we go. There's a bit of homework for me. I'll do some digging, and by the time we reconvene next week, hopefully I'll have an answer for you. I know that if that was the Bank of England, they would get advance sight, but let me leave that one with me.
Because I'm thinking it's only 2 days before, isn't it? The Fed meeting. Because it'll be
Hmm.
on the Wednesday, won't it? It'll be on the 14th. If the data's being released on a Friday, and I'm guessing it's a Friday, the 16th, then I'm guessing the Fed meeting will be on the 14th, which means that they could well get an advanced sighting. So even
Hmm.
if they don't get a totally accurate number, they'll get a guesstimate or an estimate.
Let me find out.
Okay.
I'll do some investigative journalism.
I look forward to that. So, okay, so that's. I mean, obviously, that's obviously the backdrop, the interest rate backdrop, the stock market backdrop. So ultimately, the data that we have seen this week, in summing up, hasn't been enough to sound the alarm on the US economy as yet. But obviously, we haven't seen the numbers from um, October yet, or
No,
the
and
early part of November, and I think that's going to be the acid test.
yeah, I would agree. I think, there is no need to sound the alarm just yet, but well, it sounds obvious. September was a long time ago. And we are still waiting that data to point to and to show how the economy has evolved in the intervening period.
All right. On that note, I was going to segue into UK markets on that basis, but given that on what we've just said there, we have had some early indications of how the US consumer has
Mm,
been dealing with the last few weeks. Um, in the earnings numbers from Target, Home
mm.
Depot, Walmart, and Lowe's,
Yeah, why don't we go
and
into that now? It's not quite a
yeah,
nice.
yeah, it's a nice sort of moves slightly in. And obviously ties in also to a certain extent with next week's numbers, which is US Q3 GDP, which really doesn't help us in any way, shape, or form because
Yeah.
ultimately it's up to the end of September. So it's not particularly meaningful. Anyway, let's start. Home Depot, Target, both downgraded or issued downgrades to their guidance for Q4 and the full
Mm,
year, as did Lowe's. But Walmart actually upgraded their guidance. So,
yeah.
what does that tell us about the US consumer? Because ultimately, I'm a little bit, you know, it's uncertain, I would suggest.
Yeah, I think it's very, very uncertain. And actually, those guidance moves, certainly guidance being cut into the holiday season, is not a particularly brilliant sign,
Mm.
given that we know, of course, for US retailers, the fourth quarter is by far and away the most important of the year. I would strongly agree with you. I think there are very sort of mixed signals when it comes to the consumer outlook right now. There are various spending gauges, of course. I think MasterCard put out a report saying that spending was up by 4% year on year in October. can't complain too much about that. Of course, we haven't had the official retail sales data. So, I also wonder whether there are potentially some idiosyncratic factors at play. Obviously, Home Depot or Home Depot in their earnings, essentially in more words than this, said that the weather was too good, which is why they have underperformed. Target, we know they've been in quite a lot of trouble for quite some time now. So as always, when you're trying to sort of extract macro signals from earnings reports, it's sort of 50% a signal on the broader economy, 50% a case of, well, actually, maybe it's more company specific.
Yeah, I mean, I was looking at Target's numbers, and Target's problem isn't in digital sales, where it saw some fairly decent sales growth with respect to that. Its problem is in its product mix.
Yeah.
In terms of the
It
fact
has been for some time now.
exactly that. Whereas Walmart basically shot the lights out, though they did acknowledge that there was weakness during the quarter due to the government shutdown, which saw consumer spending slow due to the pausing of SNAP benefits, which is something that we already knew.
Yes, and of course, now that the government shutdown is over, that will those SNAP payments will resume. The one thing that did make me chuckle a little bit with Target was in conjunction with their earnings, they announced a partnership with OpenAI.
I saw
mean,
that.
Is that really what they're banking on to try and turn things around? It feels a little bit. Maybe I'm being uncharitable, but are they just scraping the barrel a bit at this point?
Yeah, I mean, they are looking at costs. The new CEO, Michael Hewson, has already started to ring the changes. He's not hanging about, cutting 1,800 corporate roles and allowing customers to use Target's app within ChatGPT. Well, that's very niche. And I'm wondering how many of Target's actual customers actually use ChatGPT.
Well, exactly. It's one of those that I think it's almost designed for a press release where investors go, "Oh, AI is a big thing. They're getting in on the AI game, so we'll buy the stock." Well, as you say, the actual payoff from that, I don't think it's going to be anywhere near what the hype is.
Indeed. So basically, what we can take away from these numbers from these big four retailers is that, yes, the US consumer has been hit by the government shutdown. Obviously, federal employees as well won't have been spending money. And obviously, the 42 million Americans who are on SNAP benefits won't have been spending money in the same way that they would have been otherwise.
Yeah.
But away from that, Nvidia is selling an awful lot of chips, isn't it?
Well, it really is. I mean, we can go through the precise figures momentarily, but again, they have absolutely blown the lights out. It was a very, very high bar for Nvidia to meet this quarter, not only because of where they've set their own expectations, but also given how shaky sentiment was coming into the report. Not only did they beat on their Q3 numbers, they raised their guidance for Q4, and CEO Jensen Huang was probably about as bullish as anyone's ever heard him on the conference call afterwards. I mean, it's pretty much everything that an Nvidia bull wanted to hear, they did hear last night. And of course, the other thing was one of the things market participants have been concerned about is this idea of an AI bubble. Unsurprisingly, Jensen Huang said, we see things slightly differently. Well, given you're at the middle of this potential bubble, I'm not surprised you're saying that. But even setting that aside, I mean, it's insane. Absolutely insane, the figures this company is delivering.
I mean, Q3, they beat expectations, $57 billion, profits of $1.30 a share, which was an increase of 65%, and 32 billion, that's near as damn it, in net income.
Yeah.
And for Q4, we're looking to see $65 billion in sales, plus or minus 2%, 8 billion above what we saw in Q3.
Yeah.
And gross margins 73.4%, up on Q2, but down from this time last year. But when you're selling the amount of chips they're selling, I don't think 1.2% lower or 1% below what it was a year ago is neither here nor there. One item that I did take from the outlook was plans to accelerate 7 new supercomputers, including with Oracle, to build a huge AI supercomputer for the US Department of Energy, featuring, and get this, 100,000 Nvidia Blackwell GPUs. 100,000 just
crazy.
from one customer alone.
Yeah, absolutely that. I mean, it is absolutely crazy. And the guidance, I think, was really what market participants were latching on to after the results came out last night. And of course, again, that guidance assumes zero sales to China. So there is potential upside risk. Also, in terms of the forward looking statements, they seem to be able to keep up with demand. You know, they are not constrained by output in any way, which is another bullish factor for the stock. I think actually the Nvidia bear case, if I was to be sort of a devil's advocate, is that you would go, well, actually, you can't carry on at a 70-odd% margin forever. You would assume that at some point competitors will catch up and erode that. But we're 3 years into all this now, and nobody has. AMD haven't, Intel haven't. Nobody seems to be getting close. So I certainly wouldn't want to be betting against them. Let me put it that way.
I remember actually saying that to you about a year ago,
Yeah.
that how long can Nvidia sustain 70%, 70% margins?
Mm.
And we were talking about it then, and
Here
I
we
think
are
if we
12 months
here we
later
are
and they're
12 months
still
and we're
sustaining
still
it. Yeah.
talking about it. So I think there's a moral in that.
Mm.
Don't bet against something when the trend clearly isn't in your favor. And at the moment, with Nvidia shares, they're back above their 50-day moving average.
Hmm.
Still below $200 though, so which I think is that 5 trillion market cap.
Yes, it is. Yeah.
So is that alone enough to continue to keep the shares motoring higher? The fact that we haven't seen a further gains leads me to be a little bit cautious just on the base of that earnings number last night, because I would have
Mm.
thought that we would have seen a fairly rapid revisitation of those highs. Is it because we're towards the end of the year and people don't want to load up on additional risk?
Yeah, I think there might be a degree of that going on. I mean, let's be clear, the stock is trading up 4% as I speak. I don't think we can
Mm.
complain too much about that. But yeah, I think there is definitely an element of we've come through a bit of a shaky spell in terms of US equities at large, which will have shaken out quite a lot of long positioning.
Mm.
We are sat here today a week before Thanksgiving. We have both said that Thanksgiving is effectively the end of the year. And then you're into December when conditions naturally start to thin out and, people take off for the holidays and all sorts. So I do think there is an argument to say that actually, while the bull case for Nvidia and actually for the market at large is still a solid one and it still holds water, there is probably less conviction right now to buy
Mm.
back into the theme than there would have been a month ago, and certainly than there will be in Jan when everyone comes back and where all systems go for 2026.
Mm. Okay, so that's the US. It's taken a while for us to get round to the UK, but I
It's
think
almost like we don't want to talk about
no,
it.
I know, because essentially I don't want to spontaneously combust.
Oh, God. Oh, I know what you're going to bring up now.
No, no, I'm going to leave that.
Oh, right. Okay, fine.
I'm going to leave that. I'm going to park that
Oh, right. Okay.
for the
Listeners,
budget
you'll have to
for
stay
the
on the
week
edge of your seat there.
for the week ahead. But inflation numbers this week,
Mm.
you know, I don't get the media narrative around this. Okay, December rate cut, yay! No, the reason that they're looking at a December rate cut is because the economy is in dire trouble.
Mm.
It's not a reason to celebrate.
No, I would completely agree with that. I think the correct framing is that they are considering and probably will, in my mind, deliver a 25 basis point cut in December. And the reason why they will do that is because inflation is on its way down, which
Is it?
means, well, we can discuss that some momentarily, but
Mm.
that means that the bank have more room to pivot and say, actually, we can support the labour market, we can support the growth side of things, even though they don't officially have a dual mandate,
Mm.
as opposed to needing to remain in such a restrictive policy stance. But I don't think a rate cut is cause for celebration. I mean, yeah, fine. If you're on a variable rate mortgage, it probably is. But for the economy at large, there's not. It's not time to be popping the champagne just because Bailey and Co are going to cut 25 basis points this time next month.
But even if they do, will it be reflected in government borrowing costs? I'm not sure it will.
Well, I mean, I think we will discuss this when we come on to the budget momentarily, but I
Mm.
think the direction of gilts and gilt yields depends much more on what Rachel Reeves does or doesn't do than on anything that Andrew Bailey does or doesn't do. But you say is inflation coming down? I mean, well, Yes, it is. Inflation came down to 3.6% on the year in October, down from 3.8% in September. So that's in line with the Bank of England's forecast. I think it's pretty clear that the price pressures probably have now peaked. And we also saw core CPI come down to its lowest level since March, 3.4, and services CPI at its lowest level of the year at 4.5. Now, I acknowledge that.
Now do food inflation.
Well, I'll let you do that. But I acknowledge all of these because it ruins my argument.
But
I
everyone is affected by food inflation. Not everyone is affected by services inflation because they can choose not to go out.
Well, that is true. But what I would say is, just before we get on to that, I do recognise that on their own, these are still very high numbers. You know, inflation is still running at 1.5 times the MPC's target. Services inflation is running at 2.5 times it. However, it's the direction of travel that's important, and the direction of travel is lower, and it's the speed of that journey which is in line with the bank's forecasts, which gives them enough cover to say, okay, we're happy to pull the trigger on another rate cut now.
I mean, I take everything that you're saying absolutely spot on. You know, I can't argue with any of it. My biggest concern here, and this, I posted a graph of food inflation earlier this week on X, and it got some varied responses. Usually, the more negative ones from the dribbling classes who basically can't accept that Brexit happened 9 years ago. But nonetheless, you look at it. Food inflation at the end of last year, it's 2%. It's now 4.9, and that's by more. Food inflation here in the UK has jumped by more than it has in the US, and by more than it has in the EU. Now, someone said, "Well, what about Japan?" I said, "Well, what about Japan? You do realise they've got a very weak yen; it's at record lows almost, and they're a net importer of food and energy in the same way that we are."
Yeah, exactly. And of course, the other thing is when it comes to food inflation is that we know food prices have been rising globally. That is a fact.
That is a fact.
But of course,
absolutely,
the UK is more exposed to that, not only, as you said, in terms of being such an import-driven economy, but also because we've piled so many extra costs on food retailers recently, whether it be higher employer national insurance contributions, whether it be the packaging levy, of course, that we had, whether it be an increase in the minimum wage or the living wage, as it's now called. All of these costs have got to be passed on somehow. And if you're a food retailer, how do you pass that cost on? Well, you raise the price of the produce you're selling. And of course, that produce is food.
Absolutely.
It's not rocket science.
No, and a lot of these retailers passed on those minimum wage increases early. They didn't have to do it in April. They brought them in actually before April.
Yeah.
Because they felt that they would win brownie points from the government for doing that. Apparently not. If some of the kites that we've seen flying with respect to next week's budgets are any guide. But that's another discussion.
A very long discussion.
Anyway, I mean, basically for me, I think, yes, we could see a rate cut in December, but ultimately it's not really going to change the outlook for consumer finances or businesses by any significant degree.
No, I would completely agree with that. And I mean, again, we've spoken about this before, but a lot of that hinges much more on market-based interest rates than it does on what the Bank of England are doing. And
exactly.
Despite the BOE having cut, 5 times now, the 10-year gilt is not exactly much lower, is it? In fact, after what's happened over the last week or so, it's quite a fair chunk higher.
Yeah, and essentially, as you say, since the Bank of England started cutting rates over a year ago, there's been no discernible difference in government borrowing costs at all.
Yeah, absolutely.
Anyway, move on. We've had some numbers out this week from the likes of Imperial Brands, JD Sports. That's pretty much it, I think. And there was and I think there was a report from Dr. Martens as well, which I saw indulging some fairly decent punnery going on there.
I was going to say there were some dodgy puns flying around on that one, but we'll boot that into the long grass, I think.
Yeah. I don't think you were the sole arbiter of those puns, though, were you? Pun
I was
intended.
Not. Mr. Chris Beecham started that one, didn't he?
Yeah, well, he needs to be kicked into touch. Anyway,
God.
Imperial Brands, not much to write home about there. Fairly decent set of numbers. Shares higher on the week. Total revenue down, but profits slightly higher. Growth adjusted operating profit expected to grow in the 3 to 5% range, weighted towards the second half. And they increased the dividend as well. And it's a fairly healthy dividend as well, 4.5% to 160.3p per share. So certainly if you're an income investor, the trend there still remains reasonably positive for Imperial Brands.
Yeah, absolutely. I think you've pretty much covered everything there. There's not really much to mention. I think the stock did actually trade to almost decade highs in the aftermath of that report. But yeah,
It's still
in
there
terms of
now.
in terms of the figures themselves, it was all pretty okay, I think.
Yeah. JD Sports, on the other hand, disappointing set of numbers. Shares slightly lower today, around about 2%. Like-for-like sales, disappointing. They have been improving over the course of the last 3 to 6 months. We saw a 1.7% decline in the US, but the UK saw a 3.3% decline. And I think, again, that speaks to declining consumer confidence, margins under pressure, 30 basis points decline there, and they downgraded their expectations for full-year profits to the lower end of their window.
Yeah, absolutely. Well, one of the other things actually that JD Sports did mention, and there may be a bit of them making an excuse in this, but I also think there's some truth in
Probably.
it, is that they flagged rising youth unemployment as one of the reasons why their sales are being hit so much. Now, again, there is probably a degree of them making an excuse, but we do know that JD Sports client base does lean towards that younger end of the market. And there were figures out this week that 1 million people are out of work or not in education between the ages of 16 and 24, which again speaks to that huge divergence between fortunes here in the UK and in the US, and also just the generally ailing nature of UK PLC, I think.
Well, I also think if you actually add the number of people who are actually claiming benefits to the actual overall unemployment numbers or in receipt of benefits and don't have to work, the inactivity rate is nowhere near 5%. It's closer to 15.
Yes, I would not be
Did I
at
read
all
that?
surprised if it was.
Did I read that correctly? I can't remember. But that seemed really high to me.
Yeah. I mean, I haven't actually seen the figures myself, but I would not be surprised if it was somewhere near that level.
Because obviously I haven't checked that, but you know,
it sounds about right.
It sounds
to be
about
honest.
right. If you're thinking there's about 8 million people who are on some sort of benefit, and now obviously some of that will be universal credit top-ups and what have you, personal independence payments, but there'll also be some in that who are not required to work, and they reckon that figure is around about half of the 8 million total.
Yeah. Right.
Anyway,
shall we do it? Shall we brace ourselves? Sadly, this is water, not vodka, because that would help get through this next segment.
Unfortunately, Ribena and not red wine.
We're talking, ladies and gentlemen, of course, about the budget coming next Wednesday on the 26th.
No, I've written about that. I've written about the budget, and my opening line was, where do I even start with this? It's been a shambles. It's been a shambles even before Rachel Reeves got up and spoke to the nation on the 4th of November.
Certainly and much more polite way than I would have put it, but yes, you're absolutely right.
She basically, sort of rolled the pitch. I think the narrative that was used. She rolled the pitch for tax rises, and now appears to have done a screeching U-turn. We still don't know. I mean, we've had endless speculation on changes to pension thresholds, ISA thresholds, council tax bans. Bank surcharges. I mean, there's been so many kites flown. I'm surprised they didn't close the airspace above Heathrow Airport.
It has been ridiculous. It has been utterly ridiculous, and I will forewarn our listeners that this is going to get worse. There's going to be even more kite flying in the papers this weekend as we move towards the budget itself. And actually, I think it was John Stepek at Bloomberg who did a tally, and it was well over 100 different measures that they've trialled in the 12-week period leading up to the budget. frankly, it's been bizarre. I mean, you and I both remember the days when a chancellor would not say a word in the run up
Mm,
to the budget. I mean, back you think of the days of Kenneth Clarke, of course, way before my time, they wouldn't even be seen in public in the run
mm.
up to the budget. Whereas now you've got 2 or 3 stories a day doing the rounds as to what they may or may not do. I think one thing we can be relatively confident about is that we're not going to get an income tax hike. I think that has been, now that they've U-turned on it, they can't U-turn on the U-turn, otherwise they lose what remaining credibility they have left. So
Sorry, mate. They've got no credibility left.
well, I would agree
They're
with that. Yeah,
cooked.
I
They're
would agree.
cooked.
Well, that brings me on to another point I'll make momentarily. But it looks like the budget is going to be a series of much smaller but many more tax hikes, as opposed to 1 or 2 big measures. That, of course, raises 2 risks. One being that it raises nowhere near the amount of revenue that the OBR project it will. The second is that we have a repeat of something like the omnishambles budget that we had back in 2012, where the government is trying to do so many different things that something slips through the net and it's just an obvious clangor that goes down like an absolute lead balloon. Which brings me on to the bigger point I wanted to make, which is that I think for financial markets, the focus should be on the political fallout from all of this, as opposed to the fiscal fallout from all of this. We know that Rachel Reeves is going to meet her fiscal rules. Otherwise, she wouldn't stand up and give the budget. We know that on paper, she's going to try and build more headroom against those fiscal rules than she had in the spring. The question, the big unknown, is how does this go down with the Parliamentary Labour Party? Because I can't imagine any of it's going to go down particularly well. And we've had so many, we've almost had as many stories about potential leadership challenges as we have budget trial balloons, I think.
Mm. Yeah, I mean, which begs the question: is this her last budget?
Well, to be honest, I did think last year's budget would be our last one, but
Well, so did I, to be fair.
I will make that prediction again. I think I
The
struggle
thing,
to see how you can get to this time next year. There's a path to it, but it's an incredibly narrow path, and a lot of things have got to go right for Rachel Reeves to still be Chancellor this time next year, I think.
I think the one thing in her favour a year ago was the fact that she was seen. I'm not going to say she was seen as being competent. I'm not going to go that far. I'm going to say she was seen as the least worst option
Yes.
when it came to being the figurehead at
Yeah.
the head of the Treasury, in terms of being in charge of the purse strings.
Yeah.
This last few weeks has blown any shred of credibility that she had when it came to, is she the least worst option?
Yeah.
Because ultimately, when you look at what's lined up behind her, people are talking about Torsten Bell.
Oh, no.
Personally, I'm not even going to, I think he'd be equally disastrous, if not more so. He taxes anything that moves. So if you think she's bad, I think the bond markets would lose whatever semblance of faith they have in UK government debt sustainability if he took over. So I think it's basically, it might have been the better the devil you know 12 months ago. No, I'm not so sure.
Yeah, I think I would agree with that. And I think the mistake that they've made, and I don't think they've realised this yet, but they will in time.
Well, what about the backbenchers? I mean, ultimately, what's it going to take to wake them up from their own fiscal and economic incontinence or illiteracy, whatever you want to call it?
Yeah. Well, I think as I was going to say, I think the mistake they've made is this sort of recent rebellion, rumor, whatever it was. The big narrative that Starmer and Reeves and number 10 and number 11 were trying to push was, we are the only two that markets will accept. We are the only two that will ensure financial markets stay calm. The problem is that's not true anymore, because as we saw a couple of weeks ago, on Friday, markets have lost faith. You've just done a U-turn 2 weeks before the budget and torn the whole thing up and said you're not going to raise income tax anymore, having just rolled the pitch for it and done this emergency press conference and all the rest of it. So I think there's a real risk now that they end up getting sort of hoisted by their own petard, because they've given everyone the reason that they can use to say, actually, you told us you were the only ones who could keep markets calm. Markets are not calm anymore. It's clearly your fault. With all due respect, on your bike.
You can't control your own party, so how do you think that you're going to be able to convince the markets?
Yeah, absolutely. So I think there's two issues, and we can talk about the specific policies that are actually announced in the budget next week, because obviously we'll actually know about them then. But I think there's probably two issues right now that we can say, we should be focused on. One is the political fallout from all of this. How does that pan out? Who's out of a job? When are they out of a job? Et cetera, et cetera. The second is, what are the chances of the doom loop just continuing? You look at whatever the policies that are announced in the budget next week, you look at it in the round and you go, what's the chances that whoever the chancellor is comes back for another round of tax hikes in 6 to 12 months' time? And to be completely honest, it's a downbeat assessment, but I think those chances are pretty damn high.
Well, businesses are already voting with their feet. I mean, only this morning, Eurotunnel announced that it was basically withdrawing its investment in a fulfillment centre in Barking. And we've had Exxon earlier in the week. And the CEO of Sirius Real Estate also saying the UK is uninvestable. And we've had airlines coming out, Jet2, saying that essentially businesses are not a piggy bank to be raided at your very whim. They're just not. And I think one thing I've noticed now is businesses are becoming much more vocal about the fact we're not going to do this. We're not going to invest. Interactive Investor this morning have become the latest to withdraw from the Leeds reforms, joining a whole host of other financial institutions. The business community now is basically turning around to the Labour Party and saying, up yours.
Yeah, exactly that. And I think this is an interesting development now that businesses are starting to be much more open and much more vocal about why they are leaving the UK and why they are pulling out of these initiatives. It doesn't take a rocket scientist to work it out, but it's not looking good, is it, if we're being honest?
You have to wonder when the penny will drop. And any idea that we thought that the Treasury, with the adults in the room, was blown out of the water this week with that piece in the New Statesman.
Which actually, I'll let you deliver the killer line in a moment, but I will just say it was a very, very good piece, actually.
I haven't read it, not all of it. I've written paragraphs and what have you. But I nearly spat my coffee against the wall when I read that.
I did, because you heard my reaction to it.
If you work at the Treasury and you're a special advisor, you should know what gilt yields are. Yeah. Particularly if you're advising the Chancellor on tax and spend. And if you don't know, then who the hell gave you the job in the first place?
Well, I mean, I completely agree with you. I mean, I think it's a sackable offence if you're working in the Treasury and you don't know what gilts are, and you should be sacked on the spot. I think there's two issues.
Michael, it's not that. How did he get the job in the first place? Any financial services job that I've ever been to, I've had to do a questionnaire. To understand, Bloomberg do one. They do a questionnaire for every applicant.
I think there's two things. One is you clearly don't, or whoever this person is, clearly doesn't have the financial acumen to understand how to do their job. Number one. The second is they clearly don't have any bloody common sense either. Because if you are frankly thick enough to stand in a Treasury office and ask that question out loud, as opposed to just subtly getting your phone out and Googling it and getting the answer for yourself and pretending that you've known all along, that's almost worse, in my mind, to be honest, that they weren't sharp enough to actually pretend and try and play it off. But it just sums up the general incompetence and ineptitude of the folk that are in charge. And if you're an international investor reading that, what on earth are you going to think? You're not going to have a positive view. Let's put it that way.
I mean, most of these people who are special advisors, they're graduate caliber, right? Anyway, standards are dropping. Anyway,
let's not assassinate any more characters today.
The thing is, if you'd said something like that on a trading floor when I was working, you'd been absolutely buried.
And rightly so.
Yeah, absolutely.
Rightly so.
No hiding place.
No.
Don't even think it out loud. Look it up. If you don't know.
Exactly.
Anyway,
US data.
US data. We've got third quarter GDP, personal spending, personal income. Now, for me, US Q3 GDP doesn't really matter. We know that it's going to be around about 3.5%, 4%.
Yep.
That's really not what we're concerned about. It's what's happening after that. But nonetheless, markets are going to react to it. That's
Mm.
due out on. I mean, how how significant will those numbers be? Because obviously we've got personal spending. Do we have personal spending for September or is it October? I can't. I
Well,
must admit, it didn't occur to me. Is it October or will
well,
it be?
so this is all a bit confusing, and actually, I was trying to work this out myself earlier, and I didn't come to a convincing answer because
No,
I believe it's the October data that we get next week,
for
and
spending and income and PCE.
yeah, yep. But there
Right.
seems to be no word whatsoever on the September figures. So I don't know whether they're going to come out at the same time or at a later date. I'm not
Mm,
sure. But going back to the first point about GDP, doesn't
mm,
matter.
mm,
I think actually you could almost say for the next 9 months it doesn't matter because we know the economy has grown at a relatively solid clip in the
mm,
third quarter. The Atlanta Fed's GDP tracker is pointing to growth of
mm.
4.1%. We know, as you rightly alluded to, that the fourth quarter is going to be negatively affected by the government shutdown that may lop about 1% off the quarterly growth rate, potentially as much as that. And then we know that because everyone's got federal back pay, everyone's been reinstated to their jobs, etc., the vast majority, if not all of that lost activity, should then be recouped again in
Mm.
Q1. So the data is going to be very, very noisy and very bumpy, but it's not going to tell us a lot.
Or at the end of Q4, because if you think about it, that
Well,
recouped back pay will probably kick into pay packets just before Christmas and just after
yes.
Thanksgiving.
Yeah, that's a good point, actually. So, yeah, it could be towards the back end of Q4, which obviously, negates some of the negative shock you see at the front of it. But
Mm,
I don't think it matters much, to be honest. It certainly isn't going to impact the policy outlook particularly much.
no. Um, One thing I would say is that the personal spending numbers in the lead up to the government shutdown, June, July, and August, were 0.5, 0.5, and 0.6%. So
Mm.
they were quite strong.
Yeah, absolutely. Pretty decent. And yeah, of course, we spoke about the retailers earlier on. So
Yeah.
if you missed that, rewind.
Indeed. EasyJet full year numbers for 2025. I mean, it's well known that EasyJet generally tends to have a really strong second half,
Mm.
which more than makes up for its loss making first half.
Yeah.
Certainly, the numbers in Q3 bore that out. Profits were 50 million better than they were at the same period last year. Yet, EasyJet shares are down quite sharply from their May highs.
Mm.
Um, and I'm sort of struggling as to understand why.
Yeah, well, that makes two of us, to be completely honest with you, mate.
Hmm.
It's been a little bit of a strange one, particularly as you rightly say. I mean, where were we trading? Back in June, we were trading at almost 600p. We're now trading down at 450p. So it's been quite a
Hmm.
chunky decline that we've seen, which is odd given that entire period is typically when EasyJet have their best time of the year.
Hmm.
So yeah, I find it a little bit confusing, and you'd naturally then say, well, are the earnings that we're about to get going to potentially be a catalyst to spark a bit of a turnaround?
I would argue probably yes. I think obviously they did issue a little bit of a profits warning in Q3 because of the 25 million hit to the Q3 results from French air traffic control strikes, which was
Mm.
15 million of that. But that's nothing new with French air traffic control. They spend more time on strike than they do in work. So you'd think that you'd learn to have mitigated that by now. Um, on the other hand, people are leaving booking their trips until an awful lot later, which I think makes it much more difficult to estimate how well the airline is doing. But
Yeah, there's less.
EasyJet hot.
Oh,
Yeah,
sorry,
go
go
on.
on. Go on. No, I was going to say that there's much less visibility on future
Hmm.
bookings than you would want in an ideal world because, as you say, there's that increasing trend to just book things up at the last minute.
Yeah. EasyJet holidays, though, I think I'm going to continue to pay attention to that because that is really a strong area of growth,
Mm.
albeit a very small part of the business. But it has been doing very, very well. In Q3, it saw a 27.4% increase in revenue to
Yeah.
428 million. So there is an expectation that people are going for the package holiday as opposed to just the flight only. But certainly, I think if they can meet customer expectations or sorry, market expectations, I would say,
Mm.
then there's no reason we can't see a bounce from current levels of around about 450.
Yeah. No, I think I would fully agree with you on that.
Okay, Kingfisher, B&Q. Having
Yes.
seen what we've seen from Home Depot, I think it's quite likely that we could see a similar situation play out with B&Q. Now,
Yeah.
since August, we've seen some really decent share price gains. And I think a large part of that was because there was so much pessimism built up in the lead up to that August bank holiday downgrade from Deutsche Bank.
Mm.
That ultimately, any sort of upside surprise was likely to give the shares a significant uplift. And Kingfisher uprated their profits guidance for the year. I think the key question for me is, will that guidance hold?
Yeah, and that is the key question because, as you said, they've upgraded that guidance and the read across. I'm not entirely sure how much of a read across we can get from Home Depot last week, but the read across isn't a particularly positive one from what we've seen on the other side of the pond. So, the risk is, and it's that classic case of a company raising its guidance and then failing to meet the raised guidance. It's never a great look, and the stock would get, well, to say the least, and the stock would take a real pummeling on the back of that if that were to happen. So I think that's absolutely the thing to focus on as we move through that report.
Yeah, because Target made that mistake a couple of years ago. They upgraded their guidance in the middle of the summer, only to have to downgrade it again 3 months later.
Yeah, I mean, it's
Sometimes,
about the worst bit of sort of
yeah.
investor relations management that you can do, I think.
So just as a result of the strong summer performance, and it was a strong summer because of the hot weather.
Mm.
Kingfisher upgraded its full-year guidance for adjusted pre-tax profit to the upper end of its 480 million and 540 million pound range,
Mm.
as well as raising its estimates for free cash flow to between 480 million to 520 million. Now, the shares did hit a one-year high back in October. We've drifted off a little bit since then, but I think they really do need to deliver on their quarter, but also maintain their guidance for this year. Otherwise, the impact could be fairly brutal.
Yeah, absolutely.
We've also got Mitchell and Butlers, the full year numbers for 2025, all bar one. Those of you know all bar one. Toby Carvery, Harvester.
Yeah, a whole
Again, it's
host of
been
brands.
a whole host of brands that they own, and obviously we've seen from JD Witherspoon's how sort of beaten up that sector has been, despite the fact that JD Witherspoon's has exhibited a remarkable amount of resilience in
Mm.
the face of rising costs. Can all bar one Mitchells and Butlers do the same thing?
Well, that's certainly going to be what market participants are looking for in those earnings next week. But as you say, just looking at the chart now, it's just been a sort of steady grind lower from those highs that we saw in the summer now to, well, we're just off the lowest level that we've traded at since May. There's a lot of headwinds facing the sector, frankly. Increased input costs, increased employment costs, and then we're looking at a budget which is likely to hit consumption. And one of the potential areas of consumption that might be first to go is that sort of casual dining and evenings out slice of the economy. So you can understand why the market has priced in a relatively sort of pessimistic view of things. The question is, can they deliver anything in those earnings results that actually change that trend? And I would argue that given they report a day after the budget's probably going to have more of a role to play on that one.
Yeah, sadly, I think the budget will overshadow the actual numbers, even if they do deliver on pretty much all of their metrics, whether it be food sales and drink sales.
Yeah, I fully agree.
Halfords, two sides to that business. Obviously, you've got the MOT business, the auto centres. Similar sort of trend when it comes to the share price that we've seen with respect to Mitchell and Butlers. Peaked June, July. We've seen a slow, gradual decline since then. Did maintain its outlook for profit before tax to between 36 and 39.8 million for 2026 back in the summer. I think for me, the key question here is, can it maintain its guidance, having posted a fairly decent set of full-year results in June?
Yeah, I think I would fully agree with you on that one. That's and again, they report the day after the budget as well, so probably going to be overshadowed a little bit. But in terms of the numbers, that's the focus. Do they reiterate that guidance?
Yeah, I mean, October, they said that there was a strong uptick in like-for-like sales in the 26 weeks to the 26th of September. So I don't think we're going to see any surprises because we did see a pre-close trading update back in October.
Yeah.
So I can't imagine that there's going to be much of a share price reaction But we've given up all of those gains that we saw in October, and we're now back below the levels we were when they initially released that pre-close update.
Yeah. So we'll see what pans out there.
Okay, so we're going to finish up with a whole load of US retailers. They're releasing numbers next week. Abercrombie and Fitch, Best Buy, Dick's Sporting Goods, Nordstrom, Kohl's and Urban Outfitters. All clothing brands, all discretionary brands. I think, again, as we've seen with Walmart, as we've seen with Target, as we've seen with Kohl's, they'll give us a good indication as to how the US consumer is doing in the absence of retail sales data.
Yeah, absolutely. I think that is exactly what we'll be looking at. And of course, the one thing to bear in mind with all of those names is that they are more discretionary than they are staples. Whereas you look at, Walmart and Target, they're staples. You're going there for food and things like that. All of these names are more discretionary in nature. So of course, the spending is much more sensitive to actual changes in the economy. So maybe that message or that attempt to use them as a sort of barometer is going to tell us a little bit more than what we were able to glean from Walmart and Home Depot.
I certainly think it'll be more instructive.
I think it will as well.
Cool. Okay, well, that's it for this week. I mean, we could have gone on for a lot longer given the subject matter and the budget.
We'll save it for next week.
We'll save it for next week, indeed, because, I'm not convinced that we're going to be any more the wiser next week than we are now. But, the big question will be, will Reeves be back for more?
Probably.
Or whoever decides, or whoever gets to replace her.
Whoever draws the short straw.
Indeed. Well, on that bombshell.
Yes.
On that bombshell, we'll revisit this next week when hopefully the UK Treasury will be given a crash course in gilt yields and all other government debt related instruments and anything else. Anyway, on that cheery note, that's it for this week. See you all same time, same place next week.
See you later.